So you have two questions. The first one is around possible stock options for you, and then number two is around what you call it? Oh, second,
Um, pension system available for individuals.
okay, for individuals, particularly in Nigeria.
Yes.
So I'll start with you. So with the stock options, I like to encourage people to invest both in Nigerian stock as well as maybe the US stock exchange. The beautiful thing is that we have quite a number of apps that make it easy for you to be able to do both in Nigeria these days. For me, I use Chaka, so I'm going to be speaking based on chaka.com, and I believe they are registered with the Securities and Exchange Commission, which is another reason why I would choose them, because you want to be sure that your money is not going to be stock. I'm going to mute you so that
Yes, please.
your conversation is required. But you can unmute whenever you want to mute.
Okay.
Okay, so I'll mute you now. Okay, so I think you're muted again. So I was saying, so I like to use Chaka because they are, I know I've done a bit of background checks. I've worked with them for a couple of years, but there are others out there. You can do some research and get to know more. You don't have to do Chaka, but I recommend Chaka, so that's why I refer it. And so I'm going to be talking based on Chaka that I've used. So on Chaka, you can create a global wallet as well as a local wallet. So with the global wallet, you can invest in stock like the US stock on the US stock exchange, and you can also invest in the Nigerian stock exchange. And I'm not going to tell you that this is a particular stock you must pick because there are a lot of considerations depending, number one, on your personal value. So some people are ethical, they're called ethical investors. So anything maybe that involves child labor, any company where they are doing maybe things that are kind of shady, or you've got some information about some things that they're up to that are not exactly ethical, or in some cases, because of people's faith, for example, they may decide that they don't want to invest in a company that does alcohol or a company that produces cigarettes. So I can't say that this is the best stock for you. So you need to do that personal research yourself. But these are the things that I typically look out for when I'm picking what to invest in. First and foremost, it needs to check my value box. So once I'm okay with it ethically, then I look at personally, this is a personal decision. I try, if I'm investing in the US stock exchange, I try to pick any stock that is below 10 US dollars. If possible, below 5, but I can go up to 10. And the reason is just a mathematical reason only, because it is easier for a $10 stock to appreciate to $15 or 20 than it is for a $15 stock to appreciate to 22.5, for example, because I have a rule. Once whatever I'm investing in, once it gains 50% of the original price I bought it. So if, for example, if I bought 30 units of a $10 stock, so that means I spent $300 on it, right? And I have 30 units. Once that stock gets to $15, I'm going to sell off 20 units of that stock. No matter how well it's performing, even if it looks like it's going to be going higher, I'm going to sell about 20. The reason is that I want to recover my 300 US dollars that I initially invested. So by the time I sell 20 units of the stock, I've collected my $300 dollars back, and I still have 10 units left, right? So the 10 units I can now be that's where I will get all the gain and whatever. So whatever happens to the 10 units, I know that my initial capital was saved, right? And then I will go and invest the 300. I'll find another stock that is still a penny stock that's still below 10. So Chaka also gives you this ability to watch a stock. So when you see a stock that you want to see how it's performing before you invest, you can put it on your watch list. So when you put it on your watch list, you can be checking. Okay, so for example, let's say it was at $35. And remember, my rule is I don't want to buy anything less than 10. So if the only reason why I didn't buy that stock at the time I was ready to invest was because of the price, I can put it on my watch list. And then whenever it does crash to below $10, for as long as the underlying fundamentals are okay, I can then still say, okay, by the time maybe it falls to, unfortunately, say $9, it now fits my price criteria. And then I can also say, let me invest in this and let me buy maybe 50 units, for example. Then I'm going to go to use that my same rule, buy 50 units, wait for the price to get to, if I bought it at $9, wait for the price to get to $13.50, sell off whatever number is going to give me back my 450. I think that should be about 33 point, maybe 34 units of that. Get my money back, then put the rest, leave the rest for it to continue to appreciate. So it's the power of compounding. And the reason why I put that rule for myself is so that I don't get emotional. It's a stop. So 50% is not a magic number. You can decide that, okay, you want it to go to 70%, for example. And then but it's just to help me regulate so that I don't get too greedy or whatever and say, oh, let me see what will happen tomorrow. Maybe it will go up. No. So once it hits that my my target. So the aim of the target, whatever it is, for some people they can decide that they want to make their gain that they want to get 25%. That's fine. It's also to help you so that you don't get carried away by the market. So you know that I put in this amount. I want it to appreciate to this amount. Once it gets to this amount, I'm going to take my initial investment back. So the idea is just to give you a good time to choose to take your initial investment out of that stock and go and put it elsewhere in the same stock market. The reason why I find the US stock market easier to deal with is that is because of the data you can get. So it's not even so much about the prices, because there's still another thing I look at for me to see if a stock is properly valued. And so you need to multiply the price to earning ratio. That's called the PE ratio by the earnings per share. So you need that data. And the good thing is that for many US stock, when you're on Chaka, you can easily find the data on the page. So when you multiply the PE ratio by the EPS, earnings per share, whatever price you get there, you need to compare that price with whatever that stock is really being sold for on the stock market. If the price that the stock is being sold for is higher than what you get by multiplying the PE times EPS ratio. So for example, if the PE times EPS ratio for stock A is say $7, that's when I do the math, it's $7. And then I see that on the stock market is being sold for $15. I'm not going to even put that on my watch list because the extra $8 is just based on is just based on the market sentiment. It's just the way the market is seeing it. Because the PE ratio times EPS gives you the true price that is backed by actual what they call actual assets. So the price to earning ratio is telling you that this is the price that you should be paying and this is how much you should earn. And the earning per share is telling you that for each share that you get of this stock, this is how much you should be earning. So by the time you multiply PE by EPS, you are getting the correct price per share. So this is based on, they've done the calculation, all the assets that this company has. If they have to sell off their assets, this is how much they will get. And if you divide it by the number of shares that they have, this is what the price should be for each share that they are selling, because this is what is really backed by actual physical assets. So when you get those, and when you get that price when you get that actual price, then you use it to compare. Okay, so if the price that they are selling in the market is higher than that price you calculated, that stock is overvalued. And once there's any bad news or anything, that stock is going to crash, and it will crash very badly. But if you look at it and the price that you are getting in the market is is around the same price as what you're calculating. So that means that is fair value. You can then look at other criteria and see whether it's worth it or not. But if it is less than, if the price is selling in the market is less than the price you calculated, that's a good stock to look into, because it is most likely going to appreciate once people begin to know more about this company. So those are the types of stock that you want to. So the best thing you can do personally is to, before you put a lot of your money, first of all, get to a point where you begin to feel comfortable with how to do all of this analysis. So don't put, so for example, if you had 300K, I'm just using 300K as an example. Don't put your 300K, all your 300K at this time in investing. Put maybe like 100K. Use it to learn what you know. Then find something else to do with this. Best possible. Sorry, I have a meeting coming up very soon, so I'm going to need to round this up soon. So I'm going to go to the second. I need to take a breath. I'm going to go to the second question. So the second question, please type it again so I will remember. Please type it for me so I don't forget again. Please. Let me type the second question. Please, can you type the second question again? I'm sorry. I keep forgetting. Okay, it had to do with the pension. I remember now. It had to do with pensions. So typically your employer should be the one to register you in the with the pension funds administrators. But there's also the provision for people who are self-employed. For example, if you are self-employed, so you're already your own employer, right? And so you can approach the pension, the PFAs. So I can send you a list of the different PFAs, and you can research and make your decision on which one. I have had interactions with, I think only one anyway. I've worked with Stanbic IBTC Pension Fund Administration, but I have a friend who works with ARM. If you are also interested, I'll be happy to connect you with her if that's something you want us to do, so that she can give you good counsel on how to go. But essentially, for someone who is, for example, your organization is not providing pensions, you already do work and your employer does not. Your employer, that means your employer is going against the law to start with, because they are supposed to. Every employer is supposed to register their people for what they call it on the PFAs. So first and foremost, the employer is in breach. But okay, we don't want to quarrel and all of that. So you want to take care of yourself. So I think there's an opportunity to open a voluntary contribution account. And so that one, if you're interested, I can explore the options I can give you personally as Stanbic IBTC and ARM. Stanbic because they're the ones I use, ARM because I have a friend who works there. So I'm going to stop recording now, so you have like 5 minutes to share and ask any questions you have. I'm going to pause recording. Let me not say stop. I'll pause it so that if I need to talk again, I'll just continue recording at that time.